Hey everybody, I'm Jay. Welcome. This is smarthelping.com. We're going to go into a brand new financial model template I've got. This is for subscription box companies. So just think of any business that sells a subscription to something that they deliver to your house every month or deliver multiple things to your house every month. So there's specific assumptions and configurations so that you can model this. It's a subscription company with monthly recurring revenue. I've done a lot here with the specific things and trends I found in the industry, such as promotions, pricing tiers. I've really tried to get this thing as usable for as many subscription box companies as possible so that they can do financial modeling, create financial projections for their assumptions, whether it be a startup or ongoing operation. So what I'll do, we'll go through each tab, explain how it works, and if you want the template, the link will be in the description box below. All right, so first, global control. Here you're just defining some high-level assumptions, name of the company, the launch year. Do not touch the launch date. This is supposed to be the first month of the launch year. You'll have other assumption areas where you can adjust the start month of traffic and acquisition of customers and all that. So don't change the launch date. You can change the launch year though. You can also change the exit month. This is up to 6 years, 6 full years, 72 months. So this gives you a little bit of leeway if you're starting halfway through the first year and you still want to see a full 5 years after that. You can do that with this, the timing assumptions on this model. You can also include the terminal value or not with the yes/no selector and the exit multiple, which is going to be a multiple of trailing 12-month subscription revenue. The last thing here is cash sources. So debt funding. This, you could probably start with this at 0. And once you go fill out all the assumptions, you can come back here, see what your total equity requirement is, figure out how much you want to finance. And this model will solve for the minimum equity required based on all of the startup costs, any CapEx, any net burn, operational burn, and the cumulative effect of all that. This will say how much cash you need to keep the business operations going, keep cash above 0. And if you do put debt here, like if I put 200,000, you can see the equity required now goes down to 425, retire with no debt. The rest of these are just output assumptions from the cap table. We'll go over that later. And then you've got tax rate inputs here if you want to account for after-tax cash flow of the project. And then you've also got sanity checks down here and an exit value sensitivity. All these should always be 0. This is checking to make sure all the different tabs match up. Okay, let's get into the real meat and potatoes of this model, the revenue and growth. So what I've done here, I've got 6 acquisition channels, each with their monthly spend, the start month of that spend, and the customer acquisition cost average for that spend, and you can adjust that over time. So what this means is if you spend $10,000 a month and your CPA or cost per acquisition is $10, that means you spend $10,000, your CPA is $10, you can acquire 1,000 customers per month starting in January 2024 in this case. So that's how that math is working, and that will drive traffic via advertisements. And these could be all kinds of different advertisements, Google ads, could be offline advertisements, commercials, whatever, what have you. And then again, just a monthly spend and average customer acquisition cost, which you'll have to research what that might be. And then the math will work from there. You can see here if this CPA was only $5, we can acquire double the amount. So here in this case, we'll acquire should be 2,000 customers a month, starting in June in this case. Next up, we have organic traffic. So you can pick the start month, the starting monthly amount of organic traffic you think you're going to have, and the monthly compounded growth rate of that in each year. So in this case, 5,000 add traffic per month, and then 2% more in month 2, which in this case would be February, and then 2% more than that in month 3, etc. And then you can also define the percentage of this organic traffic that's going to sign up for a subscription. So these are your 2 main acquisition features. You've got 6 different advertisement channels. These all obviously CPA means that they've signed up and they're going to be purchasing a subscription. So that's what this number needs to represent, the CPA. And then you've got traffic and then a percentage of that that will sign up. So based on these two things, we have our total customers that are being added per month. Now I've done 6 pricing tiers. Why? Well, I wanted to be able to account for the most common scenario, which is, 3 pricing tiers with a monthly and an annual option. So here you can adjust the contract length of each pricing tier, and they don't have to be 1 in 12. This could be anything. There's essentially 6 configurations for the customers that do sign up, how much they pay per month for the subscription, which you can adjust yearly here. And if you adjust it in each year, that will adjust to however many customers are still left of each cohort. I did use cohort modeling in this. This uses the advanced retention logic that is best in practice for subscription forecasting. So you're getting the best logic possible here for forecasting. Uh, and of the 12 months, or if a subscription term is more than 1 month, that's completely fine with how I do this is they're always going to be paying monthly, but the monthly amount that subscribers are paying could be less if they're paying or if they sign up for a 12-month contract, and that's how revenue is recognized. Um, Now, what this will dramatically affect is if, let's say, type 2 is 12-month subscriptions. Well, you can define at each renewal rate, which is a renewal period, and there's, renewal 1, or essentially the life of the renewal. So the first renewal period's 100% because that's just the first period everyone signed up. Period 2 would be technically your first chance for renewal, but it's the second um, event in the customer's life since they've signed up. And in this case, for type 2, you're going to put the retention rate after 12 months. For 1, since we're doing a monthly here, the contract length is 1 month. We're saying how many customers are left after 1 month. So you can adjust the retention curves dynamically by customer type, and they could be exponential decay, they could be linear, however you want to define how many customers are left over time each time there's a renewal event. You can put those of your new customers that are signing up, you can define the percentage of them that sign up to each tier here, and then they'll go through all of that different retention logic to figure out, what's the monthly subscription revenue of each tier over time based on the pricing, the contract terms. Also, a new thing I've added here that I haven't done in a previous subscription model is promotions. So now you can say, well, in the life of a customer, how much are they paying in month 1? How much are they paying in month 2? And et cetera. And you can actually adjust this all the way to month 7. And then whatever you put in month 7 is going to be whatever the amount they pay of the full purchase price over time. And what this basically allows you to do is say, well, hey, your first month is on us. So you can put 0% for month 1, then maybe 100% for month 2. And you can just apply that to everything if that's the case for all tiers. Or maybe some tiers have promotions and some don't. So if they don't have a promotion, you can say, well, tier 6, they're going to just pay 100% of whatever the monthly price is right when they sign up. But this gives you a nice way to adjust. Let's say you get free first month, 50% second month, and then third month and on is whatever the monthly price is. And that will dynamically affect the MRR. So you can see here all the customers that are signing up, they're not actually paying until month 2. So you don't have MRR till month 2. And I did break down paying versus free customers for each tier. So you can see how that changes over time. And I did it on a consolidated level 2. So that is a new feature as well here in this model. Retention curves. All right, I think we hit everything. So this is where you're going to probably spend a lot of time figuring out, researching data about your business, trying to put in reasonable assumptions here that meet your research in a certain scenario. Make sure you use the drop downs when you're selecting dates. Okay, I think that's it for revenue. Next up, we have expenses. So here, these are fixed costs. This is like your managers, sales directors, let's say office rent, any fixed cost that you want, you could put in here. You put the description of it, the start month, and again here, don't use a drop or don't drag. You can use drop downs to select the date because these always, to get a proper forecast based on the logic, these always have to be the first day of the month. And if you drag it down like this, you can see the days start going up like 1, 2, 1, 3, 1, 4, etc. up here. So you don't want that. So you pick the start month, the monthly cost, and then if it's a salary item or not, you can hit it 1 here. If you do hit a 1 here, then that cost will be, there'll be an additional payroll tax and benefits cost that you can enter here. And that will apply to any item that's entered as a 1 over here. So we've got G&A, research and development. You've also got sales and marketing. This one's an important one because it's going to contribute to the total customer acquisition cost based on all of these costs, plus the ad spend here, which will all be aggregated and then measured against the total customers added per month to get your customer acquisition cost. And note, these are monthly costs. So you want to put in the monthly costs of each of these items, and then you can adjust it by year for up to 6 years. We've also got variable costs. So this is one considered G&A, credit card fees, and you could put the percentage of your revenue that's going to be subject to that, and then whatever your credit card fee is, and that will apply. You've also got a huge one here, which is variable cost per customer. Now, this is very important because you want to know how much is it costing you to give these customers whatever their box is each month, or multiple boxes. So in this first column here, I actually sourced it from a more detailed set down here because I wanted to make it a little bit cleaner on the variable cost section. But this allows you to define, let's say packaging costs, and you're doing this all on a per customer basis. So per customer, how much does it cost for, sending them whatever you're sending them? If it's meals, how much is your cost for all the meals that they're getting based on the pricing tier that they're in? Add in delivery, transportation costs, what cost of goods sold, whatever they're getting, you're accounting for your cost per customer in this section. And you could manually adjust it if you want to just manually put it in here, but I just thought it'd be good to have a detailed breakdown of what each customer type is, what it costs, what's costing the company to, provide them with their subscription box every month. And then you could manually adjust it in your 2 through 6. You could actually override this if you wanted. If you did override this, then the numbers you put in here would no longer flow up to here. And then years 2 through 6, these are manual, so it's kind of like here's your detailed based cost, and then you could just adjust off of that if you think it's going to change over time. Then there's other fixed costs. This would be things like potentially hosting or any other cost of goods sold that's not accounted for anywhere else that you need to account for. You can put in the monthly expected cost of those here and adjust that by year as well, and adjust the start month of each. Okay, that's expenses. We've got startup costs. These are other one-time expenses that you're going to incur before operations start that you haven't accounted for elsewhere. You can also put a reserve in here if you want to solve for the minimum equity required plus a reserve. Then it'll show you, well, technically when you get to cash, forecasted to get to 0, you'll have whatever you put in, like the reserve amount. Debt schedule. The amount financed is going to be based on what's in the global control tab for debt, but you can adjust the terms here, like the year, the loan term in years, the interest rate, payments per year, and the start month of that. CapEx, these are depreciable items, and for subscription box services, this could be, I guess if you're running your own servers, it could be anything, any office equipment, anything you're buying that's got a depreciable life. You would put the description here, the cost basis, useful life, and then the month of expenditure. And that will all flow through to the cash flow accordingly. Cap table. This is, I just always default to 100% common, 10 million shares, and then you could just define here if you're raising any money from outside sources and the percentage of profit share or percentage of equity that they're getting. You can put here. The overflow is a automatic sum based on any remaining cash that hasn't been accounted for elsewhere up here or by founders. So you can see, let's say we raised 250,000 here. You can see now that overflow went down from 522 to 272, and then let's say they're getting 10%. Then we need to adjust this back down because we're over by 10%. So maybe we'll give these founders 65%. The key is the totals in here. Top section plus the bottom section should always equal 100% when combined. But this is a pretty flexible cap table, and it solves for, again, the model solving for how much equity you need based on all the startup costs and burn and everything else. This is a minimum cash that's required as an investment to keep the thing afloat. And then you can define of that who is contributing what and how much equity are they getting, these first two. Oh yeah, put this back to 75 now. Here's your checks at the bottom. And then you can see the resulting contributions and distributions based on the operations and any positive cash flows, as well as the IRR for each individual row and each total row in aggregate. Terminal values, simple. This is just saying based on the exit multiple, total value, how much of that's going to be applied to fixed versus fixed assets versus extraordinary income. So for example, here we put 95%. That means 95% is taxable at regular income tax rate. 5% is going to your CapEx schedule. These items here, net gain or loss, and that's just going to affect taxes. If you don't want to worry about this, you can always just put 100% here. In that case, these will just be zeroed out. There'll be no effect on taxes in that case. We do have full financial statements, income statement, balance sheet, cash flow statement. So here, income statement, we've got monthly recurring revenues from subscriptions. We've got cost of goods sold, gross profit, OPEX, total operating expenses, EBITDA, which is earnings before interest, tax, depreciation, amortization. This is essentially your operational cash flow. And let's go back over to January here. Then you've got interest expense. If you've got any debt, depreciation expense, sale of assets or extraordinary income, which is what I just talked about from terminal value. You see those will flow into here, and taxes accordingly, and then net income. You don't have to include a exit. Like I said, you can hit no here, and that's fine. If you do that, you can see the income statement. You've got no exit value here. And the CapEx, these are just zeroed out for net gain or losses. And you can just show 7 years of operations and what that looks like if you wanted to not include the exit. Income statement annual, same deal as the monthly, just on an annual basis. Balance sheet, you've got your cash, fixed assets, accumulated depreciation, total assets, debt, owner's equity, retained earnings, and liabilities and liabilities and assets. Liabilities plus owner's equity will always equal your assets, and that's a check to make sure that we've done the math right. Balance sheet annual, same deal, but on an annual basis. Cash flow statement, this is kind of like your uses and sources where you can see all the cash flow from operations, investing activities, and financing activities, and the net change in cash per period. Cash flow statement annual, same deal, but on an annual basis. Then we got distribution. So this is your discounted cash flow analysis for the project as a whole, happening right here based on a discount rate you enter here, and the total contributions required, and then distributions over time. You've also got the total investor group, outside investors versus insiders, and what that looks like for distributions, contributions, and a net present value of each of those. And then you've got a chart here showing essentially outside versus inside equity and what that distributions and contributions look like each period. Executive summary, here we're just going high level and showing all the main items. So you got revenue, cost of goods sold, gross profit, EBITDA, other cash flow items. So you can see everything all the way down to cash flow per year, as well as some return metrics, IRR, equity multiple, total ROI for the project and for the investors, owners, or insiders and outsiders. Visuals, we did a lot here. So you got annual subscription revenue, annual gross profit, annual EBITDA, cumulative cash flow. This will show you when you finally break even on your initial investment as well, or the project essentially returns the minimum equity that was required when this gets above zero. Annual expense summary, customer acquisition cost. Customer acquisition cost, gross and total versus your LTV, or no, sorry, the LTV that's based on gross profit and total revenue per customer. So these two against the customer acquisition costs. So this is going to basically define how we get to this next chart, which is the LTV to CAC ratio. So this is what's the value for total customers relative to what it took, what the cost was to acquire them. So here, if it's like 25 almost, that means you're getting 25 times the customer acquisition cost from what you spent to acquire a customer. They're providing you with 25 times the value of their cost in this case, if this is 25. You've got your average monthly churn rate of customers. You've got your customer count by type, all six pricing types, and this is stacked. So this is your total customer count up top, and then you can see what makes up each of the of that total based on the pricing tier. You've got annual subscription by revenue type. So here's your subscription revenue for each type per year. You've got your monthly cash flow excluding exit value. So this is a really interesting one. This is based on all the different assumptions coming together and all the debt and everything that affects cash flow. Here's what it is. The cash flow is per month based on all of that. These curves are going to be a function of, your organic traffic coming in, your ad spend, your operational expenses, debt, and what that growth looks like. You've got average monthly revenue and gross profit per user. You've got average life of a customer. You've got the months to pay back the customer acquisition cost. And you've got your ARR as of the end month. And all this chart is doing is taking the monthly recurring revenue and multiplying it by 12 each month to get ARR. What else? Okay, we got monthly detail. So the monthly detail here, we can kind of see how all the assumptions are coming together so that we can find, we can figure out, what's the total customers added. All of these individual customers added per tier are going to flow to their respective matrix tabs, which is T1 through 6 over here. And that will apply the churn logic and retention logic from this, and mainly these two tables here. And by the way, this was a bit of a mind bender to figure out how to make it work right so we can get the right retention, or essentially amount of customers left over the life of a given customer type. But anyway, that'll flow through here so we can see customers added, customers lost, and this is based on the total customers added from ad spend and organic or viral. So total new customers, and then each of those flowing to each of the 6 tiers potentially. And again, you don't have to use all 6 either. You could zero out whatever you're not using, and that's completely fine. Let's say we didn't want to use these 3. You just zero them out, and that's no problem whatsoever. Now you can see in this case we have, we'd also want to zero out the percentage of customers going to each tier. And then you can see here now we only have tiers 1 and 2. And then you've got a consolidated count here at the bottom. You've got beginning customers, customers added, customers lost, ending period customers, and then your MRR. Now, a couple complicated things about this. You can't just take the total customers at the end of each month per tier and multiply it by the monthly revenue or subscription price in each year, because we have this funny little promotion going on. So we don't know technically how many, when you've got a lot of customers joining every month, you can't just, you don't know how many customers are actually paying and not unless you break it down. So I had to go through, run it through all the logic, and then bring the MRR back from the matrix tabs based on knowing, okay, I have X customers left for each cohort. It's X light, they're in X N number of the age, or their age is some number, and then based on the percentage that they're paying within their life cycle, you can then figure out their MRR. All of that logic you can study is happening here on T1 to T6 tabs. It's all of this here. So this is how it's happening dynamically. And this is the best way to do it. It's really the only way to do it correctly. And we've done it for all 6 tiers. So you got your MRR, consolidated MRR, average churn rate. Then we've got cost of goods sold. So this is the main one where this is how much you're spending based on the total customers that you're servicing in each tier and what their cost per month is. You've also got your other cost of goods sold, total cost of goods sold, gross profit, and you've got your operational expenses here in detail, total fixed expenses, EBITDA, debt service, other cash flow items, and then finally cash flow, and then all the detailed calculations for key metrics, essentially your KPIs. So when you add up all this stuff, we have a nice 7 or 6 year financial model for a subscription box company. If you guys want this, it will be listed at smarthelping.com under the SaaS models here. I'll put it in this, it'll be in the top section. I'll label it subscription box. You can buy that. Price will be a $125 one-time fee. It'll also be part of the bundle if you just want to buy the bundle of all SaaS products. I've done a whole bunch of different models over the years that you can see here. And again, you could buy, I've done hundreds of templates in general for a lot for SaaS, but also real estate, industry specific models, joint ventures. I'm just mainly a logic builder for all kinds of different businesses. So that's where my specialty is the best modeling techniques for different businesses and making financial projections and doing sensitivity analysis and feasibility studies for all these different things. If you want to buy everything I've ever done, you can go to the Learn More link at the top of the Financial Models tab, and you can actually get everything I've done for $9.99. There's now, I think there's probably over 160 now. I got to update this, but there's so much value here, and the Super Smart Bundle includes everything on the whole site. All right, well, that's all I got for you, and I'll take requests if you've got any ideas for new financial models that you want to see. I'm really excited about this subscription box model here. This is a really a great one. So check it out. I'll look forward to hearing from you and see you on the next one.